Today, we're doing a complete breakdown of AASB 138. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before AASB 138, companies could easily inflate their worth by keeping intangible assets, like brand value, off the books. Imagine a tech firm with a brand value of $100 million not reflecting it in any financial report. Now you'll understand how AASB 138 provides transparency and consistency in recognizing these hidden assets. AASB 138 emerged to solve the problem of intangible assets being neglected in financial reporting. Before its introduction, firms could easily manipulate their financial health by ignoring valuable intangibles, like patents. This standard mandates recognition, ensuring financial statements accurately reflect a company's true worth. It promotes consistency, making financial comparisons straightforward and credible. AASB 138 is mandatory for companies handling intangible assets, effective since 2005. Firms need to recognize these assets only if they meet specific criteria, like reliability and measurability. This eliminates the risk of arbitrary recognition, ensuring financial statements are trustworthy. It's crucial for investors who rely on accurate data to make informed decisions, creating a level playing field for all businesses. The recognition and measurement model in AASB 138 ensures entities acknowledge intangibles only if they promise future economic benefits. Measurement at cost sets a clear baseline, avoiding overvaluation. Amortizing assets over their useful life aligns expense recognition with revenue generation. Regular impairment tests protect against overstated asset values. Understanding these principles is crucial for anyone discussing intangibles in finance interviews, offering insights into transparent financial reporting. Scope is crucial in AASB 138 because overlooking exclusions like goodwill can lead to costly misstatements. Candidates often mix up inclusions and exclusions, leading to classic interview traps. For instance, thinking goodwill is covered is a common pitfall. Understanding what's in and out of scope helps avoid these errors and ensures precise financial reporting. AASB 138 includes specific intangibles like patents, trademarks, copyrights, and software. These items are significant due to their impact on competitive positioning and revenue-generating capabilities. For instance, software can represent a substantial investment, influencing both financial and strategic planning. Recognizing these items appropriately aligns with the true economic value they provide to an organization. AASB 138 explicitly excludes items like goodwill, financial assets, and deferred tax assets to prevent misapplication. Goodwill, for example, arises from business combinations and requires separate impairment testing. Financial assets have their own recognition rules and differ from non-monetary intangible assets. Knowing these exclusions can prevent common pitfalls and ensure compliance with the specific standards applicable to each financial element. An intangible asset, per AASB 138, is a non-monetary asset without physical substance, but identifiable and capable of generating economic benefits. Consider a software license. It's intangible, yet critical for operations, providing competitive advantage and revenue. Properly identifying and valuing such assets is key, as it impacts financial statements significantly, ensuring they reflect the true value and potential of the business. AASB 138 defines cost as the cash or cash equivalents paid to acquire an asset. This includes not just the purchase price, but also costs directly attributable to getting the asset ready for use. For instance, developing software internally would include developer salaries and testing expenses. Precise cost determination is crucial, as it affects future amortization and impairment calculations. Navigating AASB 138's scope can be challenging, especially in edge cases. Software developed in-house is included, reflecting its strategic importance. Leased assets, however, are not, as they follow different accounting standards. Purchased customer lists are within scope if they offer future benefits. Research costs typically fall outside, as they are expensed rather than capitalized. Understanding these nuances helps avoid misclassification and ensures accurate financial reporting. Imagine a software company investing millions into a new system. How do they record this expense on their books? The recognition and measurement model provides a structured approach for treating intangible assets, ensuring transparency and consistency in financial statements. The recognition and measurement model is essential for treating intangible assets like software and patents. We'll explore how this applies to Meridian Corporation's $10 million SaaS contract, encompassing an $8 million software license and $2 million in services. This model ensures that such contracts are accurately represented on the balance sheet and income statement. Meridian Corporation's task is to identify the intangible asset within their $10 million SaaS contract. Here, the $8 million software license stands out as the asset, due to its potential to provide future economic benefits. A common pitfall is misclassifying services as intangible assets, skewing financial metrics. Under AASB, control and future benefits are key for recognition. Building on Step 1, Meridian Corporation needs to confirm if the $8 million software license from their SaaS contract meets the intangible asset criteria. This requires it to be identifiable and controlled, providing future economic benefits. Often, companies misclassify due to overlooked control aspects. Per AASB, clear identifiability and control are essential for classification. Meridian Corporation must now assess the useful life of their $8 million software asset, established as 3 years to match the contract term. A common error is ignoring technological changes, which can shorten useful life. AASB requires that useful life reflect the duration the asset will generate benefits, ensuring accurate amortization calculations. Meridian Corporation needs to measure their $8 million software at its initial cost. This excludes the $2 million implementation services, which are not directly attributable to the asset's acquisition. A frequent mistake is incorporating indirect costs, leading to overvaluation. AASB stresses that initial measurement should strictly include directly attributable expenses. Finally, Meridian Corporation decides on the cost model for their $8 million software, which means maintaining the asset at cost minus amortization. Choosing inappropriately, like arbitrarily switching to a revaluation model, can lead to inconsistencies. AASB permits revaluation only when fair value is reliably measurable. Otherwise, the cost model remains applicable. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. For intangible assets, AASB 138 offers choices between cost and revaluation models. Disclosures are vital. They tell stakeholders how assets are valued, impacting decisions. Understanding these nuances can make or break financial accuracy. Recognition of intangible assets under AASB 138 is conditional. They must be measurable and expected to bring future economic benefits. For instance, a patent purchased for $200,000, including $10,000 in taxes, is recorded at $210,000. However, research costs, like $50,000 spent on feasibility studies, are expensed immediately. After initial recognition, AASB 138 lets you choose between cost and revaluation models. For example, a trademark valued at $150,000 might use the cost model, adjusting for amortization annually. Revaluation is viable only if there's an active market, ensuring assets reflect true worth. Impairment testing isn't routine, triggered only by specific indicators. Intangible assets sit on the balance sheet as non-current assets. For example, a $500,000 software license is amortized over 5 years, with annual expenses reflected in operating expenses. Detailed notes reveal valuation methods and assets' useful lives, critical for stakeholders assessing company health and future profitability. Disclosure under AASB 138 is vital for transparency. Knowing the useful lives or amortization rates helps predict future expenses. For instance, a brand's $100,000 value with $30,000 amortization provides clarity on valuation. Detailing revaluation methods ensures stakeholders grasp how fair value influences financials, aiding in investment and credit decisions. Imagine you're a CFO deciding on a $2 million software acquisition. Without an active market, you choose the cost model, spreading costs over 5 years, impacting profit and loss by $400,000 annually. In year 3, poor performance triggers a $500,000 impairment. Detailed disclosures on amortization and impairment are essential for maintaining investor trust and financial transparency. Meridian Corporation, a global manufacturing company, acquires a patent for $500,000, expecting it to boost production efficiency. Follow how Meridian applies AASB 138 to capture every accounting event, from acquisition to amortization. Acquiring a patent is a strategic move for Meridian Corporation, enhancing its production capabilities. Under AASB 138, patents qualify as intangible assets, requiring recognition at cost. This entry increases intangible assets on the balance sheet, while cash decreases, maintaining the accounting equation. Such investments signal growth potential to stakeholders. Amortization converts the patent's cost into an expense over its useful life, reflecting economic benefits consumed. For Meridian, this $100,000 annual charge complies with AASB 138, matching expense with revenue. It reduces net income, impacting profitability metrics, while accumulated amortization offsets the patent's asset value on the balance sheet. Conducting impairment tests ensures that asset values reflect current economic realities. Meridian's patent, now impaired by $50,000, mandates adjusting its carrying amount per AASB 138. This reduces asset value while recording an impairment loss, impacting net income and signaling potential operational challenges. Revaluing the patent captures its true market potential, aligning book value with economic conditions. Per AASB 138, this $75,000 revaluation surplus augments equity without affecting current earnings. It portrays asset appreciation, boosting balance sheet strength and supporting future capital strategies. An increased patent value necessitates recalculating amortization, ensuring alignment with the asset's revised cost. This $110,000 expense per AASB 138 impacts the income statement, altering profitability ratios but accurately depicting asset consumption. Ongoing adjustments ensure financial statements remain reflective of economic benefits. De-recognizing an asset reflects its removal from operational use. Meridian's patent, now discontinued, requires reversing accumulated amortization and recognizing a $215,000 loss following AASB 138. This impacts both income and asset figures, freeing resources for future innovation and aligning financials with current strategy. Every Big Four and investment bank interview on AASB 138 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. An intangible asset, per AASB 138, is a non-monetary asset without physical substance, like patents or trademarks. Recognition requires identifiable assets, control over the asset, and future economic benefits. A common mistake is confusing intangibles with physical assets. Remember, intangibility doesn't mean invisibility. It's about the non-physical nature. AASB 138 exists to ensure consistent accounting for intangible assets, enhancing comparability and transparency in financial statements. It standardizes how companies recognize and measure intangibles. The common trap is overlooking its impact on financial disclosures. Remember, this standard helps investors understand value beyond physical assets. Under AASB 138, research costs are expensed as incurred, while development costs are capitalized if certain criteria are met, such as feasibility and future economic benefits. Mistaking research for development is a frequent error. Key takeaway: distinguish between phases. Only capitalize development once viability is demonstrated. Amortization of intangible assets under AASB 138 is based on the asset's useful life. If finite, amortize over this period. If indefinite, test annually for impairment. Misunderstanding indefinite life assets is common. Remember, amortization aligns expenses with revenue, reflecting asset consumption. Indian Accounting Standard and AASB differ mainly in terminology and some measurement nuances. Indian Accounting Standard has more detailed guidance on impairment. A common mistake is assuming identical treatment across standards. Key takeaway: Always check specific standard details for cross-border businesses. Goodwill is not covered by AASB 138, it's addressed by AASB 3. Many confuse goodwill with intangibles under AASB 138. The reason is that goodwill arises from business combinations, not individual asset acquisitions. Remember, AASB 138 targets identifiable, separable intangibles. Calculate by identifying expenses related to development phases that meet AASB 138 criteria: feasibility, intent to complete, usability, and future economic benefits. Avoid capitalizing research expenses. AASB 138 aligns closely with International Financial Reporting Standards 38, but local nuances exist, such as specific disclosure requirements and regulatory interpretations. A pitfall is assuming exact equivalence. A CFO must disclose factors affecting amortization, impairment losses, and reconciliation of carrying amounts. AASB 138 requires transparency in assumptions and judgments. Often overlooked is the need for detailed explanation of asset life and impairment tests. Takeaway: disclosures enhance stakeholder confidence through clarity and detail. An accountant might mistakenly capitalize research costs, thinking all R&D is eligible. Only development costs meeting specific criteria qualify. Avoid confusing research with development phases. AASB 138 ensures intangibles are recognized when control, identifiability, and future benefits align. It excludes financial and exploration assets. Key definitions include intangible assets like patents, where identifiability and control are critical. The scope is specific, ensuring only certain intangibles are accounted for, emphasizing future economic benefits. Intangibles under AASB 138 are recognized once future benefits and cost reliability are confirmed. Initially measured at cost, revaluation allows for fair value adjustments. Amortization depends on useful life, finite or indefinite. Finite life assets use systematic methods like straight line, ensuring alignment with economic benefits. Beware of traps in identifying control or confusing intangibles with goodwill. Local differences in AASB can tweak IAS application. Key disclosures include amortization methods and carrying amount changes. R&D costs split between expense and capitalization. Annual impairment tests for indefinite life assets are crucial, and revaluation surplus impacts OCI. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.